Okay, we're back, and thank you for watching this video again. If you don't know who we are, please watch the first two parts of the series. And my name is Vadim, and this is Rob Mitchell, my personal mentor and the best trader I know. And we're going to go over some important topics today in regards to technical aspects of trading and a few things on trading psychology. So, right now we're going to start off with one of the questions we received from previous video in regards to your personal oil trading room, and the question was whether you also trade stocks in there. Can you tell us a little bit about that, Rob?
Sure. Yeah. Thanks for having me in today, Vadim, for the interview. It's awesome. Um, in the oil room, we trade crude oil futures. And the reason we do that is because we can trade in that market, and the moves are just gargantuan in them. And it's easy to trade, and it's fun and profitable. I'll give you an example. Just like, this morning, for example, just looking at a chart here. You just take the trades with the color changes, but you take a couple of trades here, and so $500 right there, just that. But then if you look at the day, it just goes on and on and on. I mean, I had guys reporting to me they made 140 ticks early in the day, and it's just, these trades are like $1,000 trades going on, and so once you do that, you're just not going to want to trade stocks. It's just not going to make sense to you anymore, really.
Right.
And so we don't trade stocks, but you can use the same principles to trade stocks, but our focus is on this because it's so fast.
So these are oil futures NYMEX.
Yeah. We're also we're in the process of opening a Emini S&P room, and we're building the site right now and working out the details for that. And so that gives you the opportunity to trade stocks as a collection in a leveraged position. And
awesome.
So,
Yeah, we'll talk about the ES room in future videos. So right now, let's talk about volume and how you read volume when you trade.
What I've done, I actually don't even have any charts up with volume on them, but it's a great question because most people don't really realize that markets move on low volume. Markets move on low volume, not high volume. And so a lot of books will teach you that markets move on high volume. Let me add a volume to a chart here so I can, while it loads, and then I'll help to demonstrate some of these principles. Now, there's two levels that I want to answer that question on. And the first one is the volume itself, which I'm pulling up a chart right now so I can show a couple of examples. But the other one is the notion of trading through areas of low volume. What do I mean by that? Well, when you have an area on a chart that is a low volume area where the chart and price action has not spent much time there, what that's going to do is it's going to define a low volume area. And so I'll bring back this crude oil chart. I added the volume to this. You're always going to get some volume spiking near the close, and so if I move that off, it'll rescale. Now, notice here, for example, this region right here. See how this market's going up right here?
Mm-hmm.
See how those volumes dropping off
Yes.
like that?
Mm-hmm.
When the volume drops off like that, it tells you that the market's rallying. And notice this. The market comes down like this. See these tiny little volume
Mm-hmm.
right here?
Mm-hmm.
Those bars are low volume. When the market's consolidating and not going anywhere,
Mm-hmm.
right here, what do you get? You get high volume. See?
Mm-hmm.
Markets move on lower volume. Might not always look at like the ones that we just looked at. You see this yellow line I use as a definition of lower volume. But now another thing that happens with volume reading is the notion of time at price. So I would predict, just looking at these alone, that it took more time for the market to go through this in this decline rate. The reason I know that is because the volume's a little bit higher.
Mm-hmm.
The ones over here that are really low volume, those bars occurred in just seconds.
Mm-hmm.
Okay, probably. And so if I look at the time here, it's 9:51. By the time I get down here, it's 10:02, 10:03. Okay, and so I mean it's still moving pretty quickly time-wise, but the volume's a little higher, and so that was a bit of a fight right there.
Mm-hmm.
Well, part of the reason they're fighting right there is because all these guys from earlier, there's a massive rally going up.
Mm-hmm.
And so, these guys don't believe it's going down. And so they keep buying into it, buying into it, buying into it. That's why you get these tails on these bars.
Uh-huh.
You can actually also read the volume within the bar itself by the shape of the bar.
Mm-hmm.
This is a high volume bar because it's got that big tail on there.
Mm-hmm.
Okay? See the, let me open this up a little bit. It's got that tail on there that actually goes back up above that brick of that bar right there, and then this one does it too. And then this one does it too, right here, right?
Yes.
This one does it too. All those are going to be higher volume bars. There's a fight going on. Because all these guys keep buying. Finally, they get a little bit of a hold of it, and they think they got a winner on, and then it slams them.
Mm-hmm.
Oh, see. This kind of alternation, this is a kind of trapping. Now, the ones that you see like in these bars like this with the tails on them is occurring in a little bit more micro scale. These bars are 5 ticks tall. The bricks of these bars are 5 ticks tall. And so, but on this larger scale, it comes up here, and these guys think that they're home free long again, and then it hits them again.
Mm-hmm.
And so there's this actual alternation of the volume that goes on all day, or rotation. This indicator right here, I'll move that out on its own, indicates the order flow. Okay,
Mm-hmm.
and what'll happen is when this goes lower than this point right here, I know that when this flips, it's going to get a buy, so it turns green. All right, and then this one comes up above, and so I'm looking for a sell over here. Then when it turns red over here, see what I mean is that this comes up higher. So this is a form of volume reading also.
Mm-hmm.
This is a form of volume reading also. But you have to be really careful just reading volume off of a chart because there's a suspension bridge kind of characteristic to the volume throughout the day. And let me give you an example of what I mean. If this is the open of the day, okay, if that's the open of the day, and this is the close of the day, the market's going to open up and the volume's going to spike, like we saw on this chart a minute ago.
Mm-hmm.
Well, let's go to 6 a.m., which is the open in, I'm just using a crude oil chart here. We got S&P chart back behind that. You're going to tend to see some increase in the volume right around the open. Today was a really emotional day with FOMC, and so you got this big spiking of volume near the close.
Mm-hmm.
Now, if you were to map that out, if you created a composite across many days, what you're going to see is you're going to see a spike in volume in the open, and then it's going to decline into the midday, and then towards the end of the day it's going to come back up like this. I call that the suspension bridge.
Mm-hmm.
And all the bars are like this, right? And so it ends up looking like
Yeah.
like a bridge or whatever, right? You're with me on that. So it's a suspension bridge phenomenon. So the problem becomes, for any given point in the day, what's normal volume? Well, good question. Was there a report today? Are there things driving the market? Is the market on a mission to go someplace? So a lot of things can make the volume fluctuate. So you can't actually rely on volume or a standardized volume to a large degree. You can in a relatively small time frame or time scale. So you have to be really careful reading volume, because it's a tricky little guy, and you don't want to let it fool you, because it varies at different times of the day and under different conditions. So you have to read volume fairly locally, not just in general. And so this is why I get into things. This oscillator right here, we call this the trap trader oscillator, is analyzing volume within the structure of these background color changes and within these alternations. So what it's doing is it's laying a context into the alternation of the order flow. But the background color changes themselves are looking at relatively local changes in order flow, which is another form of volume. There's a couple basic forms of volume. One, you're looking at volume as a net volume. And what I mean by that is there are trades going long and trades going short within any given bar, right? And so within any given bar, you're going to have a certain number of ticks that were buys and a certain number that were sells. And if you take the difference between those two, it'll give you the net. So like on this bar, you're going to get a net buying in it. You're going to find net buying here, a little bit of net selling here, a little bit of net buying here in general. Okay. And so what these background color changes do is they look at the total volume, they look at the net volume, and they look at the bar pattern that's doing it, and they decide whether or not you should be red or green, red for going down and green for going up. Okay. And then you lay that into the higher context. But this shows you the pulsing of the volume, and so you can see the magnitude of it, because it's just a color doesn't show you the magnitude of it. So what I know here is that there are a bunch of traders that just really bought strongly in here. It's a lot of really strong buying in here. Okay. And that's a trap. Okay. Because what happens is they buy really strong. Well, you're still inside of the structure. This is coming out, we call that a pivot retag, when this goes across and touches that bar. And this is way up here. What's going to happen is this is going to have to continue out to new highs, or it's going to turn around, because this is a decision point at this pivot right here. So it comes up and it touches that, but they way overbought in terms of the order flow. They way overbought. So there's a bunch of guys in here that if it turns around, they're trapped. They're on the wrong side. Okay. And so what happens is, as this market starts to come back down through that, and it's highly likely that it will, actually it double trapped these guys, right? Came up, came back down, and then they nailed it again. And so you end up with, if you went in and analyze the volume individually, you probably net long there, 3,000-4,000 contracts or something like that. And then what happens is this starts to roll over. Well, what happens is, some of the guys place their stop here, and some of the guys place their stop, down in here, and some of the guys, trading a little bigger, place their stops down in here. So as this starts to go, it starts hitting their stops, and see, that's what happens here. It tags that low, and then you get that tail on that bar right there going up. Okay, that's initially it's these bars getting these stops getting hit right there, and then it comes up, and they think they're going to get it long again, and they're way premature because they don't have these colors on their charts, right? and then it comes down and it starts taking out the stops. Now, here's what has to happen in order for that trend to continue. What's got to happen is new money has to step in. So every movement in price that's counter to the trend, I'm going to call this a trend because it's just A, B, C, D, right? Every movement in price that is commencing a new direction will commence with, in this case, these guys are long, with long liquidation. Okay, so these guys are long, they got their stops here, so those are sell orders, but it's not new money coming into the market. It's guys that were long who are liquidating their longs as it goes lower.
Right.
So as it goes lower, what will have to happen for it to continue is new money will have to step in in order to drive it lower. If new money doesn't step in, that bad boy is going to reverse right there, or even higher. Okay, it's going to reverse right there. That's what happened here. Okay, this is short covering. All these guys sell, 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 sell. The trap sets up right there. Okay, buy, 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 buy. Well, what you get here is probably something along the line of, if you went in and analyzed it, this is all short covering. It's all these guys going, oh my goodness, I got to get out of this, So stop, 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 stop. Gets a little retracement. They might have hopped on again, going, oh my goodness, I'm going to miss it. And then it nails them again, stops them out. Okay. And then what happens is this was probably more like new money. They stopped themselves out. They re-entered here. A bunch of new money came in, started driving it higher. It came up and then it rolled over, and then it nailed everybody again. This is what the market does all day. Okay, but the beauty of it is that you know how much of a trap you got on by these kinds of tools that are showing you how much trapping is going on. There's a lot of trapping here, and there's a lot of trapping here, and you can decide, where you're trading on this kind of basis. But as a general rule, the market's just trapping all day. It's just trapping all day, man. Anytime it exceeds a point, and so it exceeds there, buy. Okay, it exceeds there. Sell. Okay, you get trapped yourself if you hopped on that one. You re-enter or not over here, and then it traps again. You buy, and you get caught in that, and then it trapped here, and then it comes down like this, and then it trapped here, and then it just up it goes, and then that one didn't get. This is getting into the end of the day here, but this kind of stuff goes on all day in the market. When the market really starts moving, you might not get that because it's already driving, and so it can't even get enough buying to but the vast majority of the time, probably 68% of the time or something like this is what's going on. Today's a wild day.
And that yellow half line becomes kind of like a magnet too, right?
Yeah, this is the midpoint of the day. Okay, so it's the midpoint of the day, so it's 50%. Now, I was going to describe it on the second level. Okay, what's the second level of description is the notion of an open area or time at price. Okay, so what is that? All right, this market comes down like this, boom, 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 like this. Okay, and so it forms I'm not going to use that tool to do it. It forms an area from that low right there to that high right there that's open. What do I mean it's open? I mean this region has a minimum amount of selling in it, and so this is like easy going down there. I could also look at the time and see how quickly it departed from there. See, from 9:30 to 9:36 is 6 minutes down. Okay, and there's a lot of selling in there. It's trap, right? A lot of selling in there. But what's interesting is that when it rolls over, how many, I ask myself the question, how many ticks do I have before I go up to the top of the box, up to the bottom of that bar right there? See? And so, you'll look at that and you'll go, well, it's 41 to 65. That's, $240. Right? So you hop on long right there, and you're expecting a $240 trade.
I see.
You're expecting for it to go up to right there. Okay. Open zone. Is that guaranteed? No. Is this within am I describing this within a larger context? No. Because the trend is really down here. And so, but anyways, this kind of filling in happens all the time. Now, if you do that, and I don't have one of those charts right here right now, but you look for this kind of stuff on a 30-minute chart. They're called single prints. Okay. You could Google that if you're watching this. You could Google single prints in market profile. And then another one is anomalies. And if you're a room member, I have a very extensive training on the treatment of anomalies. But basically an anomaly is a region on the chart where one 30-minute period leaves a gap. Markets don't like gaps in their profiles. They like nice balanced profiles. And so it'll tend to fill those areas in. And so those are areas that you kind of want to know about on your charts because it'll give you a feel for the potential that you have. And then if you lay that into a larger framework of the statistics for the range expansion, you can get a pretty good idea where the market's trying to go and what it's trying to do. So that's two kinds of volume. Areas on a chart that leave a hole or a single print, which are low volume areas. So think about that as like a traffic jam. Okay, you're out on the road and there's just tons of cars out there on the road, right? And it's slow going, right? It's hard to get anywhere. Well, all this right here is a traffic jam. It's a traffic jam. So what that region on the chart is doing is it's setting up an area of high volume. It's setting up an area of high volume. Okay, and so the market wants to get away from that. Okay, so this is like another trap. You got a high volume area. You come down, you take it out by a little bit. You come back up into that region, and then it cycles again, traps again. Okay, and then it starts coming back. This is adding more volume to that, and then it finally comes out the other end, right in here, and makes its ascent, getting away from the high volume area. Okay, so you have the idea that the market travels through low volume areas easily, and it meets some resistance in high volume areas. So same thing as in traffic, right? I'll use a traffic metaphor. You're in a traffic jam, you can't go anywhere. The road opens up and you can travel at a nice speed and get where you're going on time, right? So that's a type of low volume, high volume kind of analysis laid into a near-term kind of volume analysis. And then also don't forget this kind of volume changes throughout the day, and you have to be very careful about reading just a total volume bar indicator on your chart. So hopefully that kind of covers volume in pretty good. We also talked a little bit about net volume. Net volume is a big deal because it's directional volume. And so when a market is moving with directional volume, it has conviction. And that's also another reason why when you look at like a total volume indicator like we're looking at here, it'll tend to be low volume, because what will happen is the net volume will end up being a really small number. And so, again, markets move on low volume. Now, another interesting thing, if you're analyzing the order book, I'll take this to a whole nother level. If you're analyzing the order book, and I don't have an indicator for that up, but what's going to happen is, as let's say the market's starting to go up, market's starting to go up, it's pushing, right? What's going to happen is you're going to start seeing just a ton of limit orders, which are sell orders, above the market at limit orders. Okay?
Stop limits?
They're limits of whatever type. Okay. So the market's starting to rally, and you see all these limit orders show up above. Well, do you know what that is? It's guys that are hoping to get out. Well, what do I know? Well, I know that markets rally on low volume, right? So as soon as those guys get out, it's going to take off. So if you looked at the order book and you go, oh man, there's all these guys trying to sell up there. Yeah. Yeah, it's going to move towards that. It's going to move towards their orders, and then it's going to blow right on through it. It's just going to, it's going to humiliate them, because they're going to end up taking a profit. Because another thing that traders do that goes, this is a good thing to bring into this discussion of volume. What traders do is they have relatively big stops, which scares them half to death, because they don't know where to get their, they're constantly getting in these traps all day. The trap, trap all day long, right? Stop out. So these guys are terrified of trading, and they're trying to get even, and they're just like, they're not rational at all. Okay, and you're literally sitting here looking at their behavior, right? And so they are, so what they'll do is, when they get stopped out, it's for a lot. And then when they get a little bit of a profit on, they can't stand it, because they're in a total state of terror from getting into all the bad trades, that they'll get out of their potentially huge winning position with a small gain.
Yes.
And so what'll happen is, that's those limit orders that I'm describing on the order book. You see the market's going up. There's all these limit orders, and you see them stacking up, stacking all these limit orders, right? You're like, oh yeah, we're going, baby, because that's dumb money getting out, and so that's part of the game. So that's another aspect of volume. But if you're looking at the order book, we have a tool, Indicator Smart has a tool called the Depth Analyzer that'll show you this. It'll show you the order book and what it's doing. But anyways, so that's another kind of volume. But those orders are orders that are about to happen, but they're only the limit orders. They're only the limit orders. And so, but a limit order is enough to kind of show you, kind of how things are going within the framework of this trapping concept and the volume concept, and the idea that markets move on low volume. Markets move easily through low volume. Those are the places you want to trade. When the market's on low volume, it's getting rid of dumb money, and it's I forgot which one I was on, but we've covered them all.
Yes.
But three basic things there about volume for you to learn. So that's quite a few things about volume.
You've covered it all.
I have, but I also, you have to be careful, because I might just have given you like 20 years of information in 6 minutes. And,
yeah, to digest.
I mean, if you want to learn this kind of stuff, you got to get into an environment where somebody knows, because you're not just going to learn that having heard it for 6 minutes.
Yes.
But that's powerful stuff. When I see that, I call it order book skewing. Okay. When I see that above my order,
well, that's another trap too, because you have people who are gonna place, not just, they're gonna try to sell there in they're gonna see all the limit orders, Like
Yeah,
say,
they're going to do exactly the opposite.
yeah, oh, I'm gonna
Yeah,
sell
they'll do
there.
exactly the opposite. But if you know, now if you lay this whole thing into the range, if you know what the expected range is
Mm-hmm.
at any given time, if you lay it into that, and like with what we do, we even statistically know what, excuse me, we even statistically know what range is expected and with what probabilities.
Mm-hmm.
So I may know that the market's going to move, 80 ticks with an 85% probability.
Mm-hmm.
And then you start seeing these other things kind of lay into that.
Right.
Um, it's pretty cool. But but so anyways, just don't discount, what I've just told you is really something that you want to make as an area of study and focus, because this is how markets work.
Mm-hmm.
We're really talking about the fundamental way that markets work. Why are there all these alternations on this chart?
Mm-hmm. Why are there traps?
Yeah, you know, it's because people do the wrong thing. If you can wrap your ability around a book like Daniel Kahneman, Thinking Fast and Slow,
Mm-hmm.
and you start seeing is Nobel Prize winning behavioral economist
Mm-hmm.
who shows you how people consistently make the wrong decisions because the logic that they're using is faulty.
Mm. So
Now,
is it the logic or the emotions?
well, see, it's driven by the emotions. See,
Mm-hmm.
it's driven by this fear thing.
Right.
People, they say in trading, fear and greed, but you can talk about fear and greed all you want, but you don't really understand what that really means. Oh yeah, fear and greed, so it drives the markets and everything. Okay, yeah, right. But what really drives the markets is this pulsing
Mm-hmm.
of collective behavior. It's collective behavior. It's not individual behavior.
Mm-hmm.
But see, the beautiful thing is, within yourself what those people are feeling, because in order to have learned to trade, you went through that.
Mm-hmm.
You were the herd,
Right.
and you behaved like that, and you figured out a way out of the trap. See? Because I've told you for as long as we've known each other, you got to do the opposite of what you feel.
Yeah. Well,
Now,
very hard.
that's true to a point, and then you start understanding kind of what you're doing, and you just try and get on the right side of it. You still get on the wrong side.
Mm-hmm.
You'll find yourself in a trap, and you're just like, oh man, I got suckered in on that one. I got pulled in on it.
Mm-hmm.
Oh, it's wrong. And sometimes you just got to be ready to reverse and
Mm-hmm. Well, what really hurts too is when you do get in a trap, when they suck you into the trap, and then you do follow, say, money management rules. Say you set a stop, and the trap is set up to take you out of the position in reverse. So then you're like, well, I was kind of right. My timing was wrong, and I did the right thing. I put the stop in, and I got stopped out.
right. Well, there's several swords on that. So let's take that just for a minute and play with that idea. Let's take trading, where you're trading relatively tight and fast, like in an intraday frame.
Mm-hmm.
Okay. Let's break it down into three components. I'm going to give 1/3 to each, 33% to each. Okay.
Mm-hmm.
So I got to I'm going to buy or sell at my trigger, whatever. Okay, I'm going to buy or sell. So let's just say, let's look at this chart right here. ES chart. Okay. ES chart. This is we call this a type 2. Okay. It's just a straight setup. We do this all day long.
Mm-hmm.
This is a sell.
Mm-hmm.
A little arrow there so you can see it. Okay, that's a sell. Okay, so I sell that, fine. That's good.
Can you tell us quickly why?
Yeah. Okay, a couple of things are happening here. Okay? We might have discussed this in previous week, but I'll cover it briefly right here. Probably the single most, well, it's in the top 5 or something, most important things I ever learned trading is that markets that are trending, not only are they low volume, which we just talked about, but the cycle length is expanding. The cycle's getting longer.
Yep.
Now that's not any big rocket science. Let's go find a place on the chart. So this area here, A, B, C, D, E, F. Okay, A, B, C, D, E, F. Right? With me on that?
Yeah.
Okay. Cycle length big or small?
Small.
Yeah, small, right? So okay, like from that high to right there is like 1, 2, 3, 4, 5 bars. 1, 2, 3, 4, 5 bars. Okay, right there. 1, 2, 3, 4. I'm not going to count the other alternation. 5 bars. So a 5-bar cycle, right? 5 bars. Okay, that's interesting, but it's consolidating. Yeah. Okay, here's a trend. Here's a trend. Here. Okay, what's it do? 1, 2, 3, and then, okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Cycle expanding? Yeah, cycle's expanding, right? When the cycle is expanding, the market's trending. When the cycle's expanding and the volume is low, the market is trending. That comes back up, you get all this choppy stuff. It's probably going to resume. To trap these guys, right? Especially when it came up in here, it's trapping. Okay, rolls over and then does the same pattern again, or something close to it. 1, 2, 1, 2. We call this a 1, 1, 2 pattern. 1, 1, 2 pattern. You learn to give these things names. You just see them like 1,000 times. It's 1, 1, 2. 1 reversal bar, 1 continuation bar, 2 reversal bars, and off it goes again, right? All these guys got trapped long over here. It's running away, hitting their stops as it goes. So expanding cycle. Well, this tool right here where I drew this, when this goes higher than this point right here, I mean, I drew that line as a slant, but the legitimate way to draw is the same way I did earlier. This is higher than that point right there. As soon as that's higher than that point right there, from a cycle length and momentum standpoint, I know the cycle's expanding. Now, an interesting thing about that is you can't just see that by looking at a chart. I probably could. I've been doing it forever. Expanding cycle. How about that one? Is that expanding? Is that expanding? This is going the other way now. It's going up. Right? This is higher. Right? Is this expanding? Yeah, it's expanding. You expect it to go up there. Okay. Is this expanding? Oh, tricky one. I traded that. That's what happens there. See, so this one's tricky. It's going up, and then you get this one. I call that a double top because it only took it out by 5 ticks. It's tricky. Actually, no. The one I did was earlier. That's the ES. I was thinking crude oil. Crude oil had a pattern like that near the close, and it really opened up. But anyways, so I know the cycle's expanding. That's what this is telling me.
Okay, so you got the type 2 divergence.
Yeah, we call that a type 2. And because I've called that a type, there's hear them call hidden divergence these days. But we were doing these things. We were doing this before anybody had named this stuff. Decades ago. And so. Anyways, I expected to go down there with the expanding cycle. Okay, and the order flow's telling me to sell. Okay, so I got 3 things, right? I've got an entry, and so I got to get the direction right. I got to be right on the direction. Okay, let's say I'm gonna place a stop above that tick right there at 76.25. Maybe 276.50, whatever, right? as a reasonable place to have a stop. You know, textbook place to have a stop. Okay, so what do I have in there? 12, 15, let's just call it 15 ticks of risk. Right? And then I'm expecting it to go lower. And so I've got to stop. And so I have to also get out at the right place, or it's just going to come all the way back up. That's another thing the markets do all day, is they come back to your entry point.
Yeah.
Which is a tough thing for intraday traders, or actually, they come back to your entry point on all kinds of charts. So then the question is, well, do I take a profit when I'm down here and potentially miss some big giant runner? Or how far do I let it go against me before I get back out again? All these kinds of questions come into play. So I gotta get into the trade in the right direction. I have to be correct within the size of my stop. So I don't want my stop to get hit, but I also don't want to take too much heat. Okay, so, and then 3, I got to get out at the right time. So I got to do 3 things right in order to be right.
Yes.
Or profitable. Well, I said 1/3 to each one of those things. And so, in general, if you just kind of like lay that out as a framework, in general, there's about a 33% chance that you can be right, because you're going to get stopped out. You're going to get out. You're not going to get out at the right place. If you don't pick your entry in the right place. And so, as a general rule, if you were 33% profitable, if you were using targets and stops, you're probably doing okay if you're 33% accurate. Of course, you want it to be way higher than that, because you cannot psychologically tolerate being right only 33% of the time, probably. And so you got to be really kind of smart about where you get these placements. So now you can kind of hybridize that to some extent, but it's a double-edged sword. I actually these days trade constant lots. Okay, if I'm trading 4 lots, I trade 4 lots for the whole trade. Okay, but like what a lot of guys will do is they'll get up 5 or 10 ticks, and they'll trade 2 lots, and then they'll get up $100, and they'll take one off, and then try and let the other one run. Okay, that's a double-edged sword, because on the times that you get stopped out,
you stopped out of all of them at the high.
You get hit double.
Right.
Yeah. And so what this does is, if your stop was 15 and you took this off at 10, then you've made it 2/3 of the 15. You took one off at 2/3 of the 15. That means on that particular one, you're going to have a really high winning percentage.
Yeah, or you would have to move the other stop to like break even or better.
Yeah. Now, right, and you can do that too, but a lot of times it comes back on the entry.
Yep, it sure does.
You get into a trade like this, okay? You get into a trade like that, and then it's against you 10, and the background's still red, and you're like, that's where watching that order flow comes in, seeing those guys limit orders, you're stacking up limits below. You probably wouldn't have seen those limits stacked up right there, because they didn't all go short yet, but they sure did over here. So you start seeing the limits stack up, and you can kind of ride that. And so you get into this situation where you can really get kind of trapped into the market structure that's occurring in a relatively tight time frame. And so what's really better to do is to know what range is expected, so that you can trade for bigger. so that when it does come back to your entry, you can go, you get up $150 a contract, and then it comes back to your entry, you're back to zero, and you don't want to get out there because you already paid the risk. You already sat through the risk. You already took the stress of the risk. If you know that the range expansion is going for in the direction that you're going, and the cycle's expanding in that direction, then you want to stay with the trade, because that's how you get caught in, $500, $800, $1,000 moves, is having that larger kind of perspective of what the market's really trying to do. So that's kind of breaking down the three components of trading. So on that note, if you use stops and you're placing them 15 ticks away in a market where 15 ticks is a random movement, and many markets are 15 ticks is a random movement, then what's going to happen is your stop is going to get randomly hit a good percentage of the time. Now, the best stop, the very best stop that I know of, and you may agree, the very best stop is one that never gets hit.
That's a very good one.
Yeah. And so this is like what I do, in my bond program. It's
it's a pretty large stop, right?
Yeah. I come in on a trade like this, and my initial stop's $1,000 away. Well, why is the stop $1,000 away? Because I'm figuring out some strategic place to have the stop? No. No. Because I don't want the stop to get hit, because I know I'm right on the trade. And so that's the strategy. So when you do that, now you've only got two components you got to worry about: where you get in and where you get out. And so now it's 50. Now you went from 33 to 50%. So you don't want your stop to be something that gets hit.
Yes.
So like if you're trading and your hit rate on your stop is high, something's wrong. Two possible things. Number one, you played it too tight. Stop's too tight. Or number two, your trade placement is bad. Trade placement is an art. And so, with my bond program, it's not so much of an art. I kind of have a couple of little tricks that I do for getting better fill. But my focus isn't on trying to have the tightest stop in the world. Anytime somebody tells me, hey, what size stops are you using? It's like, wrong question. Wrong question. The correct question is, how often do you get stopped out? Because if you never get stopped out, then who cares?
Right.
So there's a big difference between risk, and risk relates to trade placement, trade efficiency, trade placement. It's a huge difference between risk and stop. And a lot of guys have a real tough time wrapping their brain around that one. But I urge you, we've been talking about this for 10 minutes, and I urge you that there's 20 years of knowledge behind the statement that I'm saying. That you could just skim this over, just kind of being fun. But
we're going to talk about risk versus stops in the next video. For
All
sure.
right. Well, I'm not sure how much more I'll have to say about it, but we can talk about designing stops and things like that.
Yeah, I think that's important. I mean,
it's huge.
Yeah, psychologically, getting stopped out, several times in a row is.
And you're batting 33.
Yeah, I mean, you're you're going to be 50% right in the direction most of the time. The market's going to go either towards your stop or away from it.
Right.
And if it's so close, you're asking for it to, and everybody knows where you're placing those tight stops at.
Yeah, of course, they're right below the last pivot.
Yeah, like a tick or two.
Well, yeah, so that's, you know,
I think we only have time
not the
for
smartest thing.
one more topic. Um, how does the concept of 10,000 hours or 5 years of practice apply to trading?
That's a good one. Okay, what you're referring to there is Malcolm Gladwell outliers,
Mm-hmm.
right? They found that in order to get good at anything, it takes 10,000 hours.
Mm-hmm.
Well, I can tell you that's maybe true just in general. But I will tell you this. If you are being guided by a mentor,
Mm-hmm.
that number of hours could be greatly reduced
Mm-hmm.
because they could tell you what you need to be doing to do it.
Mm-hmm.
Let's take piano lessons for an example.
Mm-hmm.
If you get a really good piano teacher,
Mm-hmm.
you could excel as a pianist in 10,000 hours. Now, what's 10,000 hours? Sometimes you'll find prodigies here and there.
Mm-hmm.
But for the most part, somebody who becomes a really good pianist probably isn't doing it until they're in college, because that's how long it takes to.
Well, I know that your kids are pretty good.
Oh, they all stop.
Mm.
Stop. But I don't force the kids to. But yeah, I mean, they were remarkable during those years. But actually, Alexander's becoming a really good drummer. I mean, really. But his drum teacher is Duncan Moore. He's one of the finest drummers in the world.
That helps.
And he's a great guy. But yeah, that's what I'm saying. It really helps because you just see these like quantum leaps in skill levels in a relatively short period of time. That's why I use the music analogy for this. But if you just started on your own with no resource and nobody helping you, and you wanted to learn a trade, and you didn't buy a bunch of books that gave you a bunch of garbage information that is just going to lead you into perfect traps, because that's what anything that's been published. I'll give you an example. A guy, I don't have any trading books in here anymore, but a guy wrote a book called Trade Like a Hedge Fund.
Oh yeah, I have it right here.
Yeah, a great guy, Altucher, James Altucher. By the way, he does some inspirational blogging and stuff like that. He's a great guy, man. He's
I like his blog. Yeah.
Yeah, he's a great guy. But he wrote this book called Trade Like a Hedge Fund. Now, back about the time that that book came out, I would buy any and every trading book that came out, and I would code everything in it. Well, I coded up Altucher's stuff. It's pretty rare that a book comes out that actually tests out. But everything that he had in there, it tested out the day that the book was published. Well, what do you think happened?
Stop working.
Absolutely stopped working right then and there. So you got this guy that published a book that actually had stuff in it that worked on the day it was published, and then never worked going forward. And it's good stuff. Now, I would actually recommend reading that book, but you read it from the viewpoint of studying the kinds of thinking that's behind. It's like when I read a trading book, I'm looking at what's the thought behind this. A lot of times the guys that write in the books, if you kind of been down the road a couple of times like I have, you read the book and you're going, wow, this guy's really revealing what he doesn't know. But for most people, they might not be able to pick up on that. But another book that was really good that I would recommend if you have an inclination towards mechanical thinking and logic is Murray Ruggerio's Cybernetic Trading Strategies. It's a remarkable piece of work. And the stuff in there worked when it came out. And some of it still does. Some of it still does. Actually, that concept of cycle expansion can also be found in that book, but it doesn't say it in straight out language.
Oh.
It doesn't say it in straight out language. Well, maybe it does in some respect. Talking about cycle expansion, you don't need to learn any more than what I've told you in today's session about cycle expansion. But cycle expansion is a concept that really works. Now you can do things like fast Fourier transform, fast Fourier analysis, trigonometric regression, maximum entropy method. These are methods of identifying the dominant cycle that's going on. And so you can pull the dominant cycle and you can feed that back into your indicator. You're literally telling your indicator what the cycle length is on an ongoing basis, and it's adapting as it goes. Like, some of our indicators do this kind of stuff. Okay. And so it's very valid concept. But what's happened, back to the concept of the books, more often than not, when something comes out in a book, it won't be valid going forward. Because it's going to get read and it's going to get utilized and it's going to get morphed into the randomness that markets represent.
Especially if it's been optimized, and by the time the book comes out, you have all this new data.
Oh, totally, yeah.
But back to 10,000 hours.
Right. Now, I would say if you're starting from nowhere, well, okay, the first, I'm going to tell you what, I'll just give you a really brief history. I started trading 1978. It was my first trade. I didn't really trade. I got some AT&T stock, and I got a little bit of the bug, right? Then I bought some call options, and I was going to make $1 million in one trade. And then I got an account with a stockbroker in Detroit, oldie stockbrokers, and I was trading. Lost a lot of money. Early years. Early years. And then I felt really, really bad that I had lost all that money. And so I started approaching the market very scientifically. Very scientifically. As a matter of fact, at that time, if you had asked me, I'd say if you can't code it, it doesn't exist.
Yes.
So, actually, I've probably said that to you.
Oh, yeah. When we first met, yeah.
In the early years. If you can't code it, it doesn't exist.
Yeah.
But then I started moving towards more discretionary types of things. That's another story. But I'll try and stay on track with the question. But I spent 7 years, all of my spare time, trying to figure out a system that would work in the S&P 500 because I was getting my money back. And if you wanna, I'm probably not the guy that you wanna challenge in a fit of wills or something, because if I decide I'm doing something, I'm coming through like a freight train. It might be a really slow moving freight train in the grand scheme of things, but I just won't give up. I'm absolutely insane in that respect. I just won't give up. Well, about 7 years. Okay, 7 years coding. Nothing works. Nothing works. Now, I have a background in experimental design and statistics, educational background. So I kind of know a couple of things about measuring a system that's going to work or not. Still tricky, even though. So when I say nothing works, I mean it's just not working. Even just looking at optimization grids and seeing it's just all over the place. I'm not trusting my money with this thing, although it might have a good result. You learn what to look for after doing 10,000 of these things. So about 7 years, all my spare time, probably some days 8, 9, 10 hours. You're driving your spouse crazy because you're just in a trance all the time.
Coding.
Right. And I came up with a system.
Mm-hmm.
I owned this little restaurant at the time, and I told my wife, I go, the system's incredible. I've never seen anything like it. I'm going to run an ad in Investors Business Daily. It was $800 per ad, which to me at the time was, 10% of my income per ad or something, probably more. And I mean, there was some tension about it, and but I ran the ad anyways, and thank goodness I did, because she came down with pneumonia. We're here running this restaurant with 2 kids in the back, and I mean, it was crazy. My restaurant was popular, man. People lined up out the door to get in that place. And I was a chef, and she ran the front of the house, and she came down with pneumonia. And so that ad hit the street on Investors Business Daily. Phones started ringing. I closed the restaurant down, pretty much put a gone fishing sign on the door. And while she was in the hospital, she almost lost one of her lungs. When I went to the hospital that day, the doctor got in my face. He was angry. He said, if you'd brought her here a few hours later, she'd be dead.
Wow.
It's like, oh man, just these chills just ran through my whole body. I'm like, oh my goodness, what's important to us? Our business, our work was more important than our lives. Man, I don't go there anymore, man. Life's the most important. But then I got this call from a futures clearing firm, and they said, hey, we want to raise money for you. It just took off from there. It just exploded. It just exploded. I went from, working my tail end off. I mean, I was still working my tail end off, but the business just exploded. And so
so all those years really.
But it was probably 10,000 hours.
Oh yeah.
But I really had little or no help from anybody aside from the the books I had read and the testing I had done. I learned on my own. But yeah, 10,000 hours.
What kept you going? The failures or the vision of success?
The vision of success.
Okay.
Totally.
Because that's kind of hard to maintain after 7 years.
Yeah. Well, at some point it becomes an obsession, and then you don't even know why you're doing it.
Oh.
So you create a habit or something.
Right.
And I'm really good at forming habits. Like, I can just decide I'm going to lose 20 pounds and do it. I smoked for 19 years. One day I said, this doesn't make any sense anymore. My wife doesn't smoke. I'm going outside and having a cigarette on the porch. What's this? 19 years, just one day. Done. Never again. I've been able to do this in my life. So I'll form a habit really easily, and then you're in front of the screen just, Now are 100% of those 10,000 hours effective? No, I didn't have a mentor. And so you can learn to trade, but you're going to have to put in some time, and you probably better find somebody to help you who's actually not just scamming. Because it's easy to scam people because the reward potential is so huge. The reward potential is huge, and you nick them, nick somebody for a few $1,000s for some trading program, or 10,000 or whatever. You charge you for. I'm going to teach you some secret. Well, the problem is the secret might work today. I mean, I once had I bought a system from a guy for $5,000. $5,000. And this is what the system did. Let me see if I can just find this pattern. Here it is. Right here.
Is it the one where you sell that low?
Nah, here, I'll just draw it for you. It's easy. Let me find my eye tool. Okay. Market's going up. Like this, right? And then it forms this. but the trend is strong. It's the buy point right there. Now he had all these indicators, MACDs, oscillators, and all this stuff. But this is the basic pattern. Well, what is it? It's a trap. It's a trap. They go long here, they get stopped out, they get on the wrong side. These dummies come down here and they sell. They're going short. They got two. When this happens, two sides are wrong. These long guys were wrong. And why on earth are you waiting to get long way up here anyway? Why aren't you long down here? Why weren't you long there? So you come here. When this leg is longer, there's a good chance it's going to do this. It's called a Gartley pattern.
Isn't it also, ABC?
Yeah, you can look at it that way too. Yeah, you can look at it from Elliott.
You got 1, 2, 3, 4, 5 ABC.
Yeah. Now, what's going to happen on the oscillator, because these cycles are long and these are short? The oscillator is going to form something like this, and you're going to get this type 1 divergence against that.
Right.
Okay. Now on our oscillator, you might even get something like this, so that this forms the type 2 that we talked about earlier, and you get this. So you get a type 2 followed by a type 1. If I could find one on the chart, I'd just briefly. Probably easier to find it in crude oil. Let's see if we can find a type 2 file. Well, I'm not going to go search for you, but basically, so this is a form of a Gartley. You get this nice leg up here, and you go A, B, C. It's all inside D. It's a Gartley. That's a bullish pattern. Now, this has happened right after the crude inventory report. You see all these bars are marked 730, so that's not the best place in the world to show that. Okay, coming up. Down, up, A, B, C, D, and you get the first trap, and then it traps again, and then you get the buy right there. So with our oscillator, it's going to look like that. With our it's going to look like that. It's a type 2 followed by a type 1. Great little pattern. Great little pattern. And so it's the cycling. Now also when you do that, you're forming often you're forming some kind of a head and shoulders pattern chart.
Right.
So back to the 10,000 hours. If you're on your own and you don't have any help or insights from anybody who can really show you where to look, 10,000 hours. Because you got to learn to lose before you learn to win. I mean, I don't wish that on anybody, but that's how it ends up being.
Right.
And so you really got to find a mentor who can help you. And I mean, I didn't, and I know what was involved. And I've already declared myself insane. And unless you're also insane, it's going to take you a long time to get there, and you're going to blow out some accounts. I think I lost probably in those early years $120,000. I have people come to the oil trading room all the time. I lost $120,000 trading. Yeah, I did too.
Right. Welcome.
Yeah. Guess what? How much it cost you to go? You know, my son got accepted to NYU. It's $100,000 a year to go to school. You know, with the dorms and $100,000 a year to go to school there. It's cheap. You know, you couldn't have bought that for less anywhere. You know, I'm just being funny, but you know, you really gotta you really want to find somebody who can kind of help you out with that.
Yes.
Yeah, and take that down. Now I've had guys come in, had a little trading experience, had lost some money, so they had that under their belt.
Yeah.
The problem from there is that they're so often so fear. Their hearts just become so filled with fear that they can't really see anymore. There's all kinds of patterns of behavior. As a matter of fact, put on your list. Let's talk about negative traders and negative hallucination or something like that. Ask me about that topic, because this whole thing, I see this every day. They literally have they're literally observing something that's astounding right in front of their face, and they can't see it.
Well, they probably also already believe that they're a bad trader. So
Yeah.
then they're going to see what isn't probably there.
Now, I'm going to put it out there. I didn't come up with this, as ye believe, so shall it be done unto you. But I'm going to put it in really simple terms that, it's not Old English or something. Belief is everything. It's everything. You have one tiny little tweak in the way that you think, and everything changes. Everything changes. You see this with traders all the time too. It's like one tiny little tweak, and they go from being a loser to a massive winner.
I love it.
Well, I mean, we talked about it a minute ago too. Hey, your stop's too close. You're gonna have to bear more pain where you're wrong. And then what that's going to do is bearing more pain is going to help you to develop the skill of having a tight entry, where you get what I call zero ticks against you. It just runs away.
Right.
And so, like right now, with the techniques that I've discussed, in just today, I mean, if it's eight ticks away from my entry, I'm seriously considering that I'm wrong. But you start at 15, 17 even. A really cool study to do is to take a market and run some statistical studies and just ask yourself the question: what's random in this market? What's random in this market? And most markets about 15 ticks. So what do I mean by random? I mean that the market moved 15 ticks either way, and that's just noise. It's like like you're listening to your headset or something, and it's got this. It's just the noise, right? It's just noise. Now, another thing that can help you to stay out of those things is to trade little fake outs. So that's an inventory report like this. This one right here. Okay, it comes up. This nice run up. CD is greater than AB. You're kind of expecting an ABCD down right there. And so what does it do? Gets a bunch of guys long right there, stops them out again, and then it refires. I can guarantee you that the order book started skewing right there, and you got a little nice 20 ticks of potential.
Well, that's what you just showed is exactly the thing you drew.
Well, it didn't come out the bottom.
Yeah, except by one tick.
But yeah, and that's another thing that traders get into too, is over literalization of a pattern. I remember back in those days we were like, oh, this, the MACD must be this, and the ADX must be this, and all this, and you'd miss all these trades.
Oh, right, sure.
It just ended up being these incredible trades. You're like, wow, man, it just didn't meet the rule by this one little thing, and I missed this trade that would have made my week. Well, then that's humiliating too, and then you start having negative self-talk.
Well, the problem is also that, like, when you miss a good trade, you automatically believe that you would have stuck with it for 100% of it. So then you feel even worse about it.
You got to get your belief in alignment with reality, and that's why we use these statistics, because it keeps looking you back in the face. Okay, this was an 80% trade. I didn't take it, and it won.
Well, it grounds you.
Yeah.
Right.
And so here's that pattern right here.
Oh yeah.
A, B, C, D, the Gartley, and the refire. Okay. This is a type 2 Gartley pattern coming down. This one was that was also a type 2 right there. That fired right there. This I also call that a type 2 continuation pattern. See continuations in these things. There's another one. This stuff goes on all day.
All day long.
There's another one. There's another. Yeah, that one could have trapped you, you know. But if you're getting long up here for your first time in the day, you need to really evaluate.
I'm wrong.
You know,
Yeah.
by the time we ran a stat. We said by the time it goes 4 or 5, I don't remember. There's like a 90% chance that it's going to go against, and so you get this one, fire number 2, fire number 3, fire number 4, and then you go. You sat through all that. The market's up. You're up. The market's up 120 ticks, and you're like, yeah, man, I'm gonna hop on right there. I'm gonna get caught in
the trend is confirmed.
Yeah, the trend is confirmed. I'm going to get caught in the trade of the century, man. Crude oil is going to be $180 by the end of the day. Well, I don't think so. You've already exceeded all statistical numbers, right? Yeah. So you gotta. I used to call these first opportunity. You got to get in when you form this little head and shoulders pattern. There's the head. It's sticking out the bottom, and you got the shoulder on the right. You got the shoulder on the left. And then you had this little head and shoulders pattern that's set up here. And then if you miss that, okay, that's fine. You got the little trap that sets up right there, a little type 2 right there. Oh, if you miss that, don't worry. Catch it right there. Catch it right there. Okay. Now, hold for hell or high water. It's like, we know coming off of this level, we know with about 85% probability that's going 85 ticks. So I know it's going to 32. We'll hold for 32. But Rob, I had to sit through 25 ticks. Okay, take a profit up and hop back on. But once you go 100, once you get up above 32, start keeping it tight.
Yeah.
Because then you're gonna get this dumb money consolidation. Now we've all done it. I know you won't admit it, but I will. Ha ha ha. We've all done it. Yeah, man, it's going to the moon. It's 120 ticks. Buy, sell. Buy, stop out, sell, stop out, buy, stop out, sell, stop out, buy, stop out, sell, stop out. And then it runs again. By then you gave up. Nobody who's listening to this ever did that, right? And so you got to get on the right side of the alternations. And at the right times. We do another thing called market mapping, where we look at what are the times of the day when you can make the most money. Well, I can tell you right now, G period is not it. G period.
It's counterintuitive, since it's G money.
It's always counterintuitive. Yeah, G money. So
all right, let's wrap it up. We'll cover more interesting topics next week.
Yeah, cool.
And we will see you guys there. Thank you for watching.
Yeah, and
leave us a question if you have one. You can leave it in the comments under this video, which will be fine too. You don't have to do the form. You can just leave it in the comments on YouTube.
Cool. Okay, and thanks again for having me, and guys, thanks for letting me feed you. It doesn't. There's so much opportunity in these markets. There's so much opportunity. It's just crazy. I couldn't ever really give something away by helping them. I mean, I couldn't cheat myself or anything, and so. There's no reason to not, because the kind of principles that we're talking about here, Vadim, that you're asking these questions and we're hitting these questions, are so fundamental to market structure. They'll always work. This isn't some kind of optimized stuff that we're talking about. These are concepts that drive markets.
Right, because of human psychology that hasn't changed in the last thousands of years.
Yeah, you're wired that way. Like I said, that Daniel Kahneman. It's a tough book to get through, but boy, there's some stuff in there that you'll just go, oh my goodness, I can't even believe that. And so, it's cool. So thanks again for having me.
Thank you, Rob. Next time.
Bye, guys.
Bye.